Welcome to the deep dive. If you're managing capital, running a business, or allocating resources this morning, you probably already know the dashboard is flashing red.
Yeah, it is flashing bright red across the board.
Right. And look, you don't have the hours required to dissect the thousands of pages of financial reporting that dropped overnight. You're busy. But you absolutely need to understand the structural shifts happening beneath all that noise.
Exactly.
Yeah.
You need the signal, not the static.
So today is Thursday, March 6, 2026. And we've spent the morning tearing apart the latest editions of Business Standard, Mint, and the Economic Times to extract the vital intelligence that is moving markets and supply chains today.
And I'd say the overarching theme we're dealing with today is a massive, almost unprecedented dislocation.
Yeah, it's a huge divergence. On one hand, we're staring at a severe geopolitical shockwave tearing through West Asia. It's paralyzing physical trade routes and energy markets.
But then paradoxically, at the exact same moment, the domestic Indian macroeconomic data is printing structural resilience. I mean, rampant corporate optimism that just seems entirely disconnected from the global chaos.
It really is. Before we pull the thread on how those two realities coexist, though, I want to set a very firm boundary for today's analysis, because we are going to be discussing some highly charged geopolitical events.
Very charged.
We're covering the active, escalating military conflict between the U.S. and Iran. This now includes direct strikes, naval casualties, the whole thing. We're also going to dissect aggressive international trade tariffs being deployed by Washington. So let me be explicit to you, the listener. Neither of us here is taking a political stance.
No, not at all.
We don't endorse any specific foreign policy, military action, or trade doctrine. Our mandate today is ruthlessly clinical. We're here strictly to report the factual developments as laid out in our source material.
We care about the math.
Exactly. The math, the margin impacts, and the capital flows. That's our only lens.
Which really is the only lens that matters for survival in this environment. The geopolitical events are merely the inputs. We have to model the outputs for corporate strategy and your portfolio risk.
So let's model the most immediate output. We are on day 6 of the escalating conflict between the U.S. and Iran. The rhetoric has evaporated. It's been replaced by kinetic action. We have confirmed strikes. We have the loss of a warship.
Yeah, the situation degraded incredibly fast.
And the immediate collateral damage is hitting the global energy matrix, and it's slamming right into the Indian industrial sector. Qatar Energy has completely halted production of liquefied natural gas due to attacks on their regional facilities.
Which is an asymmetrical shock to the Indian energy grid. Look, Qatar is the bedrock of India's LNG supply.
Put that into perspective for us. What does that halt actually mean for the grid?
Well, if we look at the national energy diet, India operates on roughly 195 million standard cubic meters per day of natural gas.
Okay.
With the Qatar energy halt, 60 million standard cubic meters per day simply vanished overnight. We are talking about nearly a third of the daily baseline supply being wiped off the balance sheet instantly. And the ripple effects of a 30% supply shock? They don't take weeks to manifest. They take hours.
And we are seeing the triage happen right now. The government is understandably ring-fencing domestic piped natural gas and compressed natural gas for transport.
They have to. They cannot afford a scenario where households lose cooking fuel or public transit networks just freeze up.
Right, but that defensive maneuver essentially throws the industrial sector to the wolves. Adani Total Gas is already enforcing severe restrictions on industrial consumers.
Yeah, and the pricing mechanics are brutal.
I read that if a plant consumes anything beyond 40% of its contracted limit, Adani is billing that overage at current spot LNG prices, which are sitting around 120 rupees per standard cubic meter.
That isn't just a price hike. It's a punitive pricing mechanism designed to force immediate demand destruction.
Demand destruction. Explain how that hits the factory floor.
Imagine you're running a ceramics plant in Morbi, or say a massive glass manufacturing facility. Your unit economics just imploded. You built your quarterly forecasts on contracted, stable energy pricing. Suddenly, 60% of your energy requirement is exposed to a violently spiking spot market. You can't pass that cost onto the consumer fast enough.
The natural reaction is fuel substitution, right? The industrial executives quoted in the papers this morning are scrambling to pivot to LPG or fuel oil.
Sure, but that assumes switching is frictionless.
Which it isn't. You and I both know you don't just flip a switch on a high-temperature industrial furnace and start burning a different molecular compound.
It requires physical retrofitting. It requires altering safety protocols, changing burn rates, recalibrating the entire production line. It's a nightmare for the engineers on site.
And even if they do manage it quickly.
Even if a manufacturer has the capital and the technical agility to pivot to fuel oil within a few days, they're now buying that substitute fuel in a panic-driven market.
Because everyone else is trying to do the exact same thing.
Exactly. It's a compounding margin squeeze.
And this squeeze extends far beyond the factory floor. So, let's look at the maritime choke points. The Strait of Hormuz is effectively a parking lot.
A very dangerous parking lot.
Mint's maritime tracking data shows 37 major vessels currently trapped. They're unable to secure clearance or insurance to exit the Gulf.
Now, the government has been quick to point out that India holds a 25-day strategic stockpile of crude and product diesel.
Right, so the systemic fuel crisis is theoretically delayed for a few weeks.
Yeah, a 25-day buffer prevents immediate sovereign panic, but it offers zero comfort to a private exporter whose working capital is tied up in a stranded container right now.
Because the broader issue is the secondary capacity crunch. Major global shipping lines are declaring the Gulf a no-go zone.
They are refusing cargo entirely.
And when vessel capacity drops that drastically, the cost of securing a box on the few ships that are actually willing to run the gauntlet just skyrockets.
The Indian Rice Exporters Federation is in full-blown crisis mode over this. They are facing such an acute shortage of containers that they're lobbying the Commerce Ministry to officially declare a force majeure event across the sector.
Which is a massive legal and financial maneuver. For those listening who might not deal in international shipping contracts, what does that actually do?
A sovereign-backed force majeure declaration is essentially an act of God clause. It's the only way these exporters can shield themselves from ruinous contractual penalties for delivery failures.
Because buyers in Europe or Africa don't care about a geopolitical standoff in the Gulf.
Exactly. They care about their inventory arriving on time. If the Indian government steps in with a formal declaration, it provides legal cover.
But there's a downside to that, right?
A huge downside. It signals to global buyers that the Indian supply chain is highly vulnerable to regional instability. It damages long-term reliability.
And while bulk commodities like rice can sit in a silo for a few weeks if they absolutely have to, other sectors just don't have that luxury.
The pharmaceutical sector is a great example. They are projecting a $500 million hit.
$1 billion.
Just from freight delays and exploding insurance premiums. You can't leave temperature-sensitive biologics sitting on a dock.
Speaking of things sitting on a dock, the most visceral data point today is the perishable goods. There is $382 million worth of agricultural exports, primarily bananas.
Literally rotting.
Literally rotting at various port facilities because the outbound ships simply aren't moving.
It's the physical destruction of capital in real time. You have agricultural producers who grew, harvested, and packaged their product only to watch their entire seasonal revenue decay inside a steel box on a dock.
It's devastating. And if we look beyond the surface level of the ocean, the infrastructure damage is hitting the digital supply chain just as hard.
The undersea cables?
Right. 3 out of the 15 primary undersea telecommunications cables traversing the Red Sea have been severed.
Including massive data arteries like CCOM and the TGN Gulf cable.
People tend to conceptualize the internet and cloud computing as something ethereal, like it's just in the air.
Yeah, the cloud is just somebody else's computer.
Yeah.
And it relies on highly fragile physical infrastructure sitting on the ocean floor.
And when you lose 20% of the fiber optic capacity in a vital choke point, you force massive global data rerouting.
Which introduces latency.
Exactly. And if you're running high-frequency trading algorithms or managing a globally integrated enterprise resource planning system, say your Indian manufacturing hub needs real-time sync with your European distribution centers.
Those milliseconds of delay actually matter. The physical war is directly degrading the digital operational efficiency of multinationals.
So to sum up segment 1 here, you have a scenario where an Indian manufacturer is paying exorbitant spot prices for energy. Their outbound physical product is trapped at a port. Their freight costs are up 300%.
And their digital communications with overseas clients are suffering latency issues due to severed cables.
By every fundamental metric, the corporate environment is deeply hostile.
Highly toxic.
Which brings us to this massive disconnect I teased at the beginning.
Yeah.
Because if you look at Dalal Street over the last 24 hours, you would think we were in the middle of a golden age of peace and prosperity.
The cognitive dissonance is staggering.
The market initially reacted the way you would expect. We saw a 3-day, 4% bleed as the conflict escalated. But then, an aggressive, seemingly irrational bounce.
A massive rally.
The Sensex ripped 900 points higher, closing just north of 80,000. The Nifty 50 surged 1.2% to close near 24,766. I looked at this and how does a market gap up 1% while supply chains are actively freezing?
It's the ultimate manifestation of the forward-looking nature of capital markets, combined with a very specific, aggressive intervention.
Explain that forward-looking part first.
Institutional investors are not pricing the market based on today's localized supply chain agony. They are pricing it on what they believe the corporate earnings landscape will look like 12 to 18 months from now.
So they see this as a blip.
They view the West Asia conflict as a severe but ultimately transient dislocation. When the index dropped 4%, algorithms and value investors saw fundamentally sound companies suddenly trading at a discount to their intrinsic value, and they stepped in to buy the dip.
But let's be honest, it wasn't just organic bottom-up value hunting. There was a massive thumb on the scale regarding currency stability.
Oh, absolutely. The RBI was not playing around.
Because currency dictates foreign institutional flows. The Indian rupee was getting hammered, hitting a fresh low of 92.30 to the dollar.
And foreign investors hate currency depreciation. It eats directly into their dollar-denominated returns. If the rupee falls, their actual yield collapses.
So the Reserve Bank of India stepped into the market.
And they stepped in with a sledgehammer. Market dealers estimate the RBI dumped between $5 and $6 billion in a single trading session.
$6 billion?
Yes. They aggressively sold dollars from their FX reserves and bought rupees to artificially constrain the supply of the local currency.
But I have to question the sustainability of that strategy. I mean, intervening with $6 billion in a single afternoon is a massive flex of financial muscle.
Huge.
And it worked temporarily. The rupee pulled up 0.6% to 91.61. It made it the best performing Asian currency yesterday. But if this geopolitical standoff grinds on for 3 or 4 months, the RBI cannot afford to burn $6 billion a day.
No, of course not. That's an annualized burn rate that would deplete the reserves completely in a matter of months.
So what's the end game?
They absolutely cannot maintain that velocity of intervention, and they aren't trying to. The $6 billion wasn't an attempt to permanently peg the currency. It was a shock and awe tactic.
Designed to break speculative momentum.
Exactly. The RBI knows that currency traders will pile onto a downward trend. They'll start shorting the rupee to accelerate its fall. By stepping in with overwhelming volume, the RBI burns those short sellers.
So it's a warning shot.
It's a very clear message to the currency markets. Do not get against the rupee right now, or we will wipe out your positions. It creates a floor of fear among speculators, buying time for the broader macroeconomic fundamentals to stabilize.
And that stability is crucial for veteran capital allocators who are looking past the immediate noise. Business Standard ran a fascinating interview with Jim Rogers this morning.
Yeah, he's making some massive moves.
For those who don't follow him, he's a legendary cyclical investor, and he's making some structural bets that validate this shift away from traditional Western strongholds. What did you make of his positioning?
Rogers' moves are highly instructive right now. He has completely liquidated his positions in U.S. equities.
All of them.
He's out. He's looking at the American market and seeing a decade-long bull run fueled by easy money, resulting in what he considers dangerous overvaluation. He believes a structural correction is inevitable, regardless of the immediate geopolitical news cycle.
So where does a multi-billion-dollar portfolio rotate to when it abandons Wall Street?
Rogers is pivoting hard into long-term commodities. He specifically highlighted agriculture and metals.
Which makes sense given the supply chain breakdown we just talked about.
Exactly. He's playing the thesis that global supply chain fragility, like the kind we are seeing right now in the Red Sea and West Asia, will create persistent, long-term supply constraints for physical materials.
Driving a multi-year commodity supercycle.
Right. And crucially, he is reallocating capital into Asia. He remains highly bullish on India's demographic and structural growth story.
But the other part of his Asia thesis was a bit surprising to some.
Yeah, he is eyeing a massive multi-year bull market in China.
Despite everything.
Provided Beijing continues to execute structural reforms, he is looking for assets that are out of favor but hold deep intrinsic value. And right now, Chinese equities are trading at historic lows.
We will definitely dig into that Chinese structural shift in a moment, but I want to contrast this capital reallocation with what we're seeing in the traditional banking sector. Morgan Stanley is laying off 2,500 employees across investment banking and wealth management.
Yeah, that's a huge headcount reduction.
But the cognitive dissonance here is that they just reported a record year for revenue in 2025.
It is a critical signal about the changing nature of financial labor. When a Tier 1 investment bank posts record profits and still cuts 3% of its highly compensated workforce, they're not reacting to a revenue crisis.
They're restructuring for a new technological reality.
Exactly. We are likely seeing the leading edge of AI integration in high finance. Think about it. If an internal AI model can draft pitch books, analyze financial models, and synthesize M&A data faster than a floor of junior analysts.
The bank just doesn't need that headcount.
They don't. They are protecting their margins ahead of what they perceive to be a highly volatile few years.
They're also likely preparing for a massive dry-up in global liquidity, particularly from the Middle East. The sovereign wealth funds, the Gulf SWFs, they are facing a severe contraction. Forecasts show their oil revenues are expected to plunge by 33% in 2025.
Dropping to around $1.38 billion.
That 33% drop fundamentally alters the global private equity and venture capital landscape, doesn't it?
It changes everything. For the last decade, Gulf SWFs have been the ultimate dry powder providers. They have funded massive infrastructure projects, underwritten late-stage tech startups, fueled global M&A.
If their primary revenue engine, petrodollars, is impaired by a third, what happens?
Their capital allocation committees will drastically shift their mandates. The era of writing blank checks to Silicon Valley or Indian tech unicorns is pausing. They will be forced to repatriate capital.
Prioritizing domestic investments to stabilize their own regional economies amidst the ongoing conflict.
Precisely. Which means if you are an Indian late-stage startup relying on a Series E check from a Gulf fund to maintain your valuation, you might find that well completely dry.
Domestic Indian capital markets and banks will just have to fill that massive funding void.
And that's a tall order.
It is. So this brings us to the structural realities of the two massive economies flanking India. China is undergoing a deliberate, historic deceleration, while the U.S. is rewriting the rules of global trade through aggressive tariffs. Let's look at Beijing first. China has officially set its 2026 economic growth target at 4.5% to 5%.
This cannot be overstated. This is a generational pivot.
Because for 3 decades, the entire global economic model was predicated on China delivering 8, 9, or 10% annualized growth.
Right. They were the world's factory and the world's primary consumer of raw materials. Setting a target below 5% is an official concession by Beijing.
A concession that the hyper-growth era driven by debt-fueled real estate and cheap export manufacturing is officially over.
It's an acknowledgement of severe structural drag. They are fighting entrenched deflation, which is an absolute nightmare for an economy built on high leverage.
Why is deflation so dangerous for them?
Because if prices are falling, the real burden of debt actually increases. Corporate margins collapse. And consumers delay spending because they know goods will be cheaper next month.
Combine that with a youth unemployment crisis, and you have an economy that requires an entirely new operating system.
And that new operating system is deep tech.
The 5-year blueprints out of Beijing make it clear they aren't trying to resurrect the old model.
No, they're taking the capital that previously flowed into ghost cities and low-margin electronics, and they are funneling it directly into state-sponsored technological supremacy.
Aggressively funding quantum computing infrastructure.
Rolling out 6G networks way ahead of the global curve.
And pouring billions into embodied AI and humanoid robotics. I really think the global market is fundamentally mispricing this pivot. People look at the sub-5% growth target and assume China is collapsing.
But if they successfully transition from being the dominant supplier of cheap plastic goods to being the dominant supplier of next-generation quantum intellectual property and AI hardware,
they become a much more formidable, higher-margin competitor on the global stage.
Absolutely. They are essentially conceding the battle for low-cost labor to places like Vietnam and Bangladesh, and they're attempting to leapfrog the U.S. and Europe in foundational future technologies.
Speaking of battling with Vietnam and Bangladesh, India is currently locked in a brutal game of tariff chess with the United States. And we really need to dissect the mechanics of this because it dictates the survival of the entire Indian export sector.
Yeah, to understand the current panic, we have to look at the legal sequence of events over the last few months.
Walk us through it.
Initially, the Trump administration utilized aggressive executive authority to impose varied tariffs. During that period, India played a very smart diplomatic game. They successfully negotiated an 18% specific tariff rate with Washington.
And that 18% wasn't just a random number. It was a relative shield. While India was at 18%, competitors like Indonesia and Bangladesh were stuck at 19%. Vietnam was hit with 20%. And China was facing punitive rates up to 34%.
So India held the absolute advantage in South Asia.
But that advantage vanished overnight.
It did. The U.S. Supreme Court stepped in and struck down the legality of those country-specific targeted tariffs. They ruled that the administration had overstepped its constitutional trade authority.
And the retaliation from the White House was swift.
In immediate response to the court ruling, President Trump invoked Section 122 of the Trade Act of 1974.
For our listeners, what does Section 122 actually do?
It is a very specific, blunt instrument. It allows the president to impose a blanket global tariff, regardless of allied status or prior trade agreements, for up to 150 days to combat severe balance of payment deficits.
So he slapped a flat 10% global tariff on everything.
Everything. And the Treasury Secretary is already signaling an intent to push that to the maximum legal limit of 15%.
So the playing field was abruptly leveled, but at a much higher cost of entry for everyone.
Right. If you're a global apparel brand deciding where to source your next million units, you look at India and Bangladesh and see they both face the same 10 or 15% U.S. entry tax. Suddenly, the only differentiator is baseline labor and logistics costs.
Which severely hurts India.
It does, which is exactly why the Commerce Ministry is in emergency negotiations right now. They are desperately trying to forge an interim bilateral trade agreement to bypass the Section 122 blanket tariff.
Because for Indian exporters, the absolute percentage matters far less than the relative percentage.
Exactly. They don't mind paying a 12% tariff as long as Vietnam is forced to pay 15%. Trade always flows to the path of least regulatory resistance.
Yet despite this global trade volatility, the collapsing Gulf capital, and the supply chain paralysis we talked about earlier, the domestic Indian data is printing numbers that just defy logic.
The animal spirits are alive and well.
Let's look at the corporate formation data. Fresh registrations of companies and limited liability partnerships, LLPs, have hit an all-time peak. Company registrations are up a staggering 41% year over year, crossing 2.15 lakh.
And LLPs surged 44% to over 86,000.
Why the explosion in formations right now?
This is the domestic economy overriding global macro fear. When you see a 40% surge in new corporate entities, it tells you that domestic entrepreneurs and ground-level capital allocators believe the internal Indian market is large enough and expanding fast enough to absorb new competition.
Regardless of what is happening in the Strait of Hormuz.
Right. They're not looking at global freight. They're looking at local demand.
And the high-frequency consumption indicators really validate that belief. GST collections rebounded nicely, up 2.8% in February. That completely reverses the negative print we saw back in November.
The GST recovery is solid.
But the nuance in the FMCG data is what caught my eye. The traditional narrative is always that urban India consumes while rural India lags. But the December quarter data shows the gap between urban and rural volume growth is aggressively narrowing.
Yeah, there was some temporary noise in the data previously, mainly due to supply chains recalibrating to the new GST 2.0 compliance frameworks, which caused some transient softness. But the underlying trend is very clear. Rural purchasing power is stabilizing and catching up.
This creates a much broader, more resilient foundation for domestic consumption.
It does. And what do you think is fueling this expansion?
Cheaper capital.
Exactly. The banking data reveals that the share of sub-9% bank loans has risen considerably.
That is the crucial accelerant. The cost of domestic credit is softening.
If you're a mid-market manufacturer looking to expand capacity, or say a real estate developer launching a new project, a sub-9% interest rate vastly improves your project's internal rate of return. It lowers the hurdle rate for capital expenditure.
So while the global cost of capital might be highly volatile, the domestic pipeline of credit is acting as a massive tailwind for Indian enterprise.
It's insulating them.
Okay, so we've established the macro environment. We have a hostile, fractured global landscape contrasted against a surging, credit-fueled domestic market. Now we need to look at how this specifically translates into corporate strategy. Let's break down some sector-specific maneuvers, starting with the industries caught directly in the geopolitical crossfire.
The aviation sector is the textbook casualty of the current environment.
Let's use Indigo as the proxy here. Their stock took an absolute beating yesterday, plunging 12.3% in a single session. And when you look at their operating matrix, you completely understand why. First, aviation turbine fuel, ATF, has spiked to $74.48 a barrel.
Which hurts, but the fuel cost is really only half the equation.
What's the other half?
Route efficiency, which has been virtually destroyed. Because the West Asia airspace is now an active conflict zone, international carriers are forced into massive, sweeping detours.
Right. If you're Indigo, operating flights from major Indian hubs to European destinations, you can no longer fly the direct corridor over Iran or the Gulf,
You're rerouting thousands of miles out of the way.
which fundamentally breaks their unit economics.
Yeah.
A longer route means you burn significantly more of that $74 a barrel fuel.
It means you incur higher staffing costs because crews hit their legal flight time limits much faster.
It means increased wear and tear on the airframes. And crucially, it means the aircraft spends more time in the air for a single journey, which reduces the total number of flights that specific plane can execute in a 24-hour cycle.
Your asset utilization rate just plummets. Air India looked at this exact calculus and simply suspended their Tel Aviv routes entirely. Geopolitics is quite literally redrawing the map of global aviation, and it is bleeding the carriers dry.
But while logistics and aviation suffer, we're seeing immense strategic aggression in sectors insulated from physical supply chains. The domestic financial services sector is undergoing a massive, rapid diversification.
It feels like an arms race for the Indian consumer's total financial life cycle.
It really does. Let's look at the joint ventures announced today. Angel One, which traditionally dominated the retail broking space, is partnering with LiveWell to launch a digital-first life insurance entity.
A smart lateral move.
But the real earthquake is Geo Financial Services. They announced a 50-50 joint venture with the Alliance Group to enter the reinsurance market.
Geo entering reinsurance is a structural market shift.
Break that down. Why is reinsurance such a big deal?
Reinsurance is the business of insuring the insurers. It requires massive balance sheet strength, incredibly complex risk modeling capabilities, and deep pools of patient capital. By partnering with a global behemoth like Alliance, Geo is signaling that they don't just want to offer retail loans or payment gateways.
They intend to underwrite the foundational risk of the entire Indian corporate and financial sector.
Exactly. They're building a financial conglomerate designed to capture margins at every conceivable layer of the economy.
But not everyone is finding success in financial diversification. Tata AMC made a very quiet but highly significant announcement that they are fully exiting their alternative investment funds, or AIFs.
Which really highlights the regulatory and competitive friction hidden beneath the headline growth. Tata didn't exit because the market is shrinking. They exited because the architecture of the market changed.
How so?
The tax code governing AIFs has become increasingly punitive and complex. It's compressing the net returns they can offer to high net worth investors. Furthermore, the rise of special investment funds, or SEFs, which operate under different regulatory arbitrage and offer more bespoke, aggressive structuring.
They basically cannibalized the traditional AIF market share.
Exactly. Tata looked at the compliance costs, the tax drag, and the rising competition, and decided the return on equity in that specific niche was no longer justifiable.
It's a great example of disciplined capital allocation, knowing when to fold a hand. But we need to talk about the companies that are pushing all their chips into the center of the table. We cannot review today's news without discussing the sheer magnitude of the global AI pivot led domestically by Reliance Industries.
The numbers attached to Reliance's proposal are almost difficult to process. They're projecting a $110 billion investment pipeline.
$110 billion. And it is vital to understand where that capital is going. For the last 2 years, the AI narrative has been entirely dominated by software. Large language models, chat interfaces, generative text.
But Reliance is looking past the software layer. They recognize that artificial intelligence is rapidly transitioning from a software industry into the most capital-intensive heavy industry on the planet.
They are pouring this capital into massive AI data centers. They're aiming to bring 120 megawatts of raw AI compute capacity online just in the second half of 2026.
But the real genius of the Reliance strategy is the integration. You cannot run 120 megawatts of continuous high-intensity compute on the standard grid without facing massive cost volatility or causing rolling blackouts.
Right. The cooling alone requires immense power.
So the $110 billion isn't just for servers. It is heavily allocated toward building captive, dedicated, renewable energy infrastructure. Solar and wind parks specifically designed to feed these data centers.
They're building an end-to-end, self-sustaining AI ecosystem that controls its own energy inputs.
It's an infrastructure play, not just a tech play.
And while reliance builds the physical foundation, we are seeing the anticipation of advanced AI radically alter consumer behavior right now. Look at the wearable tech sector. Smartwatch sales globally dropped by a stunning 24.3%.
Which is a classic Osborne effect.
Explain the Osborne effect.
It's when consumers stop buying current products because they know a massive technological leap is right around the corner. Consumers have realized that the current generation of smartwatches are essentially just notification screens for their phones. They know that the next generation of wearables launching in late 2026 and 2027 will have native, localized AI agents built right into the silicon.
So why buy a stagnant piece of hardware today when you know a highly intelligent, proactive assistant will be strapped to your wrist in 12 months? The consumer is pausing capital expenditure to wait for the tech to catch up.
And the tech giants are rushing to fill that expectation across every conceivable vertical. Amazon rolled out Amazon Connect Health today.
Yeah, I saw that.
It's a highly specialized AI tool engineered entirely to automate medical documentation and patient intake. It's attempting to eliminate the massive administrative drag in healthcare systems.
It's a high-margin enterprise application of AI that solves a very specific, expensive human bottleneck. Yeah, I get that one. But the consumer applications are getting incredibly aggressive and, frankly, a bit dystopian.
Oh, yeah.
Meta announced they are reintroducing facial recognition technology into their Ray-Ban smart glasses. The stated use case is that you can look at a person in a meeting or on the street, and the AI will instantly identify them, pull their LinkedIn profile, and feed you context about who they are in real time through the glasses.
Which completely shatters any remaining illusion of public anonymity and opens up a labyrinth of privacy legislation nightmares.
Oh, absolutely. And if you thought facial recognition was invasive, wait until you hear about Molt Match.
Molt Match! This is wild.
The sources highlight this as the fastest growing trend in the social tech space. It is an AI agent that you deploy onto dating apps like Tinder or Bumble. You give it your parameters and it autonomously creates your profile, swipes on potential matches, and conducts initial chat conversations with other humans or, hilariously, other AI agents entirely without your participation.
Two bots just flirting with each other.
Exactly. You only step in when the AI has successfully negotiated a physical date.
It is the ultimate commodification and outsourcing of human intimacy. We are literally using massive server farms to automate small talk.
Which is exhausting just to think about. And if the anxiety of AI-driven dating gets to be too much, the sources note you can always subscribe to DOG-TV.
Wait, what?
DOG-TV, a streaming service specifically engineered with modified frame rates and color grading to entertain your dog while you are at work. The consumer tech landscape has completely fractured into hyper-niche, highly automated absurdities.
It's a strange world.
But let's pull this all back to reality. We have covered a staggering amount of ground today. From severed undersea cables and LNG pricing mechanics to deep tech pivots in China and AI dating agents. If you are managing a portfolio today, you need this synthesized.
Definitely.
We are not going to read you a generic top 10 list. Let's have a strategic conversation about the 10 structural developments from today's data that will actually dictate long-term capital allocation. Let's alternate.
Okay, I'll start. If we distill everything we've discussed, development number 1, the most glaring red flag for any portfolio manager is energy and logistics vulnerability. The Qatar LNG halt and the 300% spike in container freight costs prove that global supply chains have zero slack.
You can no longer look at a company's price-to-earnings ratio in a vacuum.
Right. You have to interrogate their energy contracts. Are they heavily exposed to spot markets? Do they have fuel substitution capabilities? A highly profitable manufacturer today will bleed cash tomorrow if they rely entirely on just-in-time global shipping.
Number 2. When you look at how localized that pain is, it redefines how we view certain sectors, the aviation and logistics profitability squeeze. Indigo's collapse today proves that airline and global logistics stocks are essentially uninvestable as long-term holds right now.
They're high beta trading proxies for geopolitical conflict. Their margins evaporate the moment a missile is fired in the Middle East.
Number 3. While physical trade is hostile, the financial architecture is being fiercely protected. The central bank assertiveness. The RBI's $6 billion intervention isn't just a currency trade. It is a sovereign guarantee of stability.
For foreign institutional investors, this is the ultimate green light. It shows the central bank is willing to weaponize its massive FX reserves to compress currency risk. It makes Indian equities and debt far safer for dollar-denominated funds compared to other emerging markets.
Exactly. Number 4, combine that currency stability with the sheer force of domestic corporate animal spirits. The 40% surge in new company and LLP registrations isn't just a fun statistic. It is the leading indicator of the next decade of Indian equities.
We're looking at a massive structural pipeline of future mid-cap companies being born right now.
Number 5, cheaper domestic credit. Those new companies are being incubated in an environment of cheaper domestic credit with sub-9% loans rising. That provides the runway they need to scale, fueling capital-heavy expansions.
Number 6. The contrast with China's structural reset couldn't be sharper. The sub-5% target from Beijing permanently re-rates how capital views Chinese growth. You can no longer invest in China expecting a rising tide of consumer consumption and real estate development.
But you can't ignore them either.
No, because their pivot to deep tech and embodied AI means that in 5 years, they won't be competing with India on cheap textiles. They'll be competing with Silicon Valley on quantum computing supremacy.
Number 7, the new era of tariff volatility. With blanket 10 to 15% U.S. global tariffs in play, the era of free trade is dead. Supply chains must now be judged entirely on geopolitical flexibility and regulatory arbitrage rather than pure cost efficiency.
India's ability to negotiate relative tariff advantages will make or break export sectors.
Number 8, financial sector diversification. While global trade gets more complex, the domestic financial sector is consolidating power. Giants like Geo and Angel One entering reinsurance and life insurance signal a major expansion and hyper-competition. They're building walled gardens to capture every rupee of financial friction.
Number 9, AI transitions from software to hard assets. Reliance's $110 billion bet shows that the next phase of AI isn't just chatbots. It's massive physical infrastructure, data centers, and the renewable energy grids required to power them. The winners won't just be coders, they'll be the utility owners.
And finally, number 10, the Gulf sovereign wealth contraction. The projected 33% drop in Gulf oil revenues means global private equity and startups that relied on easy SWF capital will face a much tighter funding environment. Domestic capital will have to step up.
We've mapped out the entire board.
We really have. You are now fully briefed on the macro crosscurrents, the supply chain fractures, and the micro-level corporate strategies shaping the business world as of this morning.
It's a lot to digest.
But before we sign off, I won't leave you with a thought regarding that AI dating agent, Match. We laughed about AI autonomous agents swiping on Tinder and negotiating small talk for us. But strip away the dating app interface and look at the underlying technology.
The capability is staggering.
You have an autonomous agent capable of analyzing parameters, matching with counterparties, and conducting nuanced multi-turn negotiations without human oversight. As these models get exponentially faster and more capable, how long is it until those hotbots become trade bots?
It's a terrifying thought.
Imagine a scenario 12 months from now where your company's AI procurement agent is autonomously negotiating complex, multi-million-dollar supply chain contracts with a vendor's AI sales agent, executing the deal in milliseconds. Imagine autonomous algorithmic agents managing institutional portfolios, moving billions of dollars and shifting entire markets based on their own opaque internal logic, completely detached from human emotion or manual oversight.
We're heading there faster than people realize.
The future isn't just coming. It's already making our decisions. Thank you for joining us on this deep dive. Until next time, keep analyzing and keep exploring.